Global financial markets registered one of the most volatile and surprising sessions in recent years this Monday, second, driven by statements from the United States. President Donald Trump, who warned of an imminent big wave in the conflict involving Iran and regional powers. The communication, broadcast on national networks and amplified through social media, triggered a massive capital reallocation between asset classes. With a particularly notable movement, the flight from traditional precious metals toward the cryptocurrency market. In an interval of approximately 60 minutes, it is estimated that about $120 billion migrated to digital assets, signaling a possible transformation in risk perception by institutional and retail investors. The initial reaction in commodity markets was intense and immediate. Gold and silver, historically considered safe havens in moments of geopolitical uncertainty, suffered significant selling pressure. Spot gold, which was trading around $4,900 per ounce, dropped to $4,800. A decline of 2.05% that eliminated approximately $750 billion in global market value. Silver showed an even more pronounced movement, plummeting from $95 to $88 per ounce. A 7% retracement in less than 2 hours, with an estimated impact of $370 billion. Analysts point out that part of this selling pressure may be related to forced liquidations of leveraged positions and a rapid reassessment of the risk premium embedded in these assets. In the opposite direction, the cryptocurrency ecosystem experienced a robust capital inflow. Bitcoin, the market's main digital asset, surpassed the psychological mark of $68,000, advancing about 5% in less than an hour and adding approximately $60 billion to its market capitalization. Ethereum also registered a strong recovery, returning to the $2,000 level with a gain close to 5.8%, while other large-cap altcoins followed the upward movement. Consolidated data from analysis platforms indicate that the crypto sector as a whole incorporated about $100 billion in market value in an extremely short period, with approximately $80 million in short positions being liquidated, suggesting a covering movement by traders who had bet on the continuation of the correction. Despite the initial volatility, the cryptocurrency derivatives market demonstrated a relatively resilient structure. Funding rates in perpetual contracts remained at low levels, indicating balance between buyers and sellers. While open interest, a measure representing the total number of open contracts, declined only about $1 billion, suggesting that speculative leverage was not excessively elevated before the movement. This scenario contrasts with previous episodes of high volatility, in which forced deleveraging amplified price oscillations. The relative stability of derivatives may signal greater market maturity and growing participation of institutional investors with long-term strategies. Historically, periods of geopolitical tension have tended to favor gold as a protective asset, given its characteristic as a store of value, unlinked from traditional financial systems. However, the reaction observed this Monday raises important questions about structural changes in investor behavior when facing macroeconomic and political risks. For a new generation of wealth managers and tactical allocation funds, digital assets like Bitcoin have come to be seen not merely as speculative instruments, but as valid components of diversification strategies and hedges against monetary devaluation and institutional instability. Experts highlight that the observed capital migration may reflect a combination of factors. The perception that cryptocurrencies offer greater portability, divisibility, and resistance to capital controls in crisis scenarios. The growing integration of regulatory infrastructure that provides greater legal security to investors. And the narrative that Bitcoin, with its limited supply and predictable issuance, functions as protection against expansionary monetary policies that frequently accompany periods of conflict. Furthermore, the accelerated digitalization of global financial flows has facilitated the rapid reallocation of resources between jurisdictions and asset classes, amplifying the speed of market shock transmission.